So I built my software company, iContact, from 0 to 50 million in revenue over 10 years. And I sold it for $169 million by the time I turned 27. Now I'm actively helping more than 500 SaaS companies scale through SaaS Rise, the community for CEOs and founders of SaaS companies. And in the last few years, we've helped businesses like Tatango scale from 5 million to 50 million and instantly scale past 45,000 paying customers. And in this video, I'm going to walk you through exactly how I'd build and sell a $100 million SaaS company if I had to start all over again from scratch. Let's start with the foundational mindset. Unit economics is the core foundational principle that is essential to understand for scaling. Now, you do need about 10 to 20 customers first before the numbers start to make sense and the math really starts to math. And so spend that first 6 months, that first year, doing everything you can to bootstrap, get your first 100 active users and get your first 10 paying customers. How? Through organic search, through affiliate marketing, through trade shows, through going door to door, cold email, whatever you have to do to get those first 10 customers. Once you get those first 10 customers, you can start doing math and start breaking down your unit economics, which is the profitability and revenue of an incremental new customer, so that you understand how much you get in revenue from each new customer and how much you're willing to pay in sales and marketing costs to get that customer in the door. Knowing your numbers is the foundation before you can scale anything. And when you get to about 200,000 or 300,000 a year in revenue, that's about the time when you can really start to make it a mathematical model. Let's start with the first key unit economic, ARPA, average revenue per account. Now, it's as easy as that. You just take total revenue divided by total customers, and you get ARPA. ARPA is usually calculated on a monthly basis, and sometimes if it's calculated annually, it sometimes can be called ACV, annual contract value. Once you know how much you earn per month or per year per customer, then you need to calculate your monthly account churn or your annual account churn. You need those two numbers to be able to calculate your customer lifespan, which is the number of months or years a customer stays with you on average. You just take 1 divided by your monthly churn to get your months of life. So if your average churn is, say, 4% per month, well, that's on average about 25 months of life. And if your average churn is 2% a month, good job, that's pretty good. That's 50 months of life over a 4-year lifespan. You can also do the same thing with years. So if your average annual churn is about 20%, then that would be a 5-year lifespan. You multiply your ARPA times your months of life to get your lifetime value, your LTV. That's the most important number because that's how much revenue you're going to generate over the lifespan of a customer. Once you know your LTV, you can estimate what your target CAC should be. Your target CAC should be about 1/6 of your LTV. So if you have an LTV of $10,000, your target CAC should be about $1,666. That's the magic number, about a 6-to-1 LTV to CAC ratio. You can push it to 4-to-1 if you're a venture capital backed startup where you're not worried about profitability. And if you're bootstrapped and really concerned about profits, you can go to an 8-to-1 LTV to CAC ratio. So once you know your LTV to CAC ratio, you're off to the races. It's time to scale up with your mathematical model. You can also use the rule of thumb of 50% of an ACV, 50% of your annual contract value. That can be your target CAC as well. Anywhere from 50 to 75% would mean a 6 to 9 month payback window of your upfront sales and marketing costs coming back to you in terms of revenue coming in the door. So if you know your LTV to CAC ratio, it's time to go. It's time to scale. This ratio is what separates companies that scale from companies that don't. And for any recurring revenue business, you need to know your LTV to CAC ratio. Now, last thing I'll say, how do you calculate your CAC is very simple. Total sales and marketing spend in a month divided by the total number of customers acquired in that month. You could also do the same calculation on a quarterly basis or annual basis. We obsessed on these metrics. Through that obsession, we were able to scale to 70,000 paying customers, 50 million in ARR, and a $169 million sale. Now, back then, it was much harder to calculate these numbers. We had to be part of the SaaS world early on when this science was really just developing. Today, we have tools like Barometrics or ChartMogul or FinCom that make it easy to calculate all of these metrics automatically syncing up with your billing system. It all comes back to ARE, acquisition, retention, and expansion. And my other favorite acronym, AIDA, attention, interest, desire, action, or as I like to say, ADARE, which adds retention and expansion to the bottom of the marketing funnel. That is the full SaaS marketing funnel. Now let's cover the path to 1 million in ARR, bootstrapping your first customers, and finding product market fit. Let's talk about the specific steps to go from 0 to 1 million in ARR. So at the beginning, when you're building your company to the first million in ARR, you got to do whatever it takes to save money. I remember sleeping in the office, working all night long, and doing whatever I could to save money so that we could scale up. We really did everything that we had to do to get those first 10 customers in the door, even going door to door to local restaurants there in Chapel Hill, North Carolina. We didn't raise venture capital money early simply because it wasn't available to us in North Carolina as an 18-year-old and 21-year-old co-founding team. We had no choice but to get to 500,000 or $1 million in revenue before any investors would speak to us. So we had to figure out how to generate revenue, product, and customers, the three things you need before spending a lot of money on team or marketing. We did customer support on the phone ourselves. We did customer email support ourselves, and we iterated on the product based on user feedback. We finally found product market fit, we felt, when we had our 100th paying customer, which took us about 1.5 years to get to. When we started seeing customers coming back, being willing to pay, and when we got our monthly account churn under 4%, which meant that an average customer stayed over 25 months, we knew we had product market fit. So these were the signals we looked for at iContact when we were scaling up. And these are the signals that our clients today at SaaSRise, like Instantly, Tatango, Clearstream, and many others look for as well. So if you're a B2C company, you look for things like engagement rate, amount of time someone spends on your web app, how often they come back, what your bounce rate is on your website. And if you're a B2B company, you look at things like what's the average contract value and how many new customers and how many new SQLs can you get in a day. Bootstrapping forces discipline, and discipline creates results. Now let's talk about how to scale from 1 million to 10 million in ARR and how to really build the growth engine. Now, going from 1 million to 10 million, it's about building a multi-channel growth engine that makes your brand omnipresent, that ensures that the people in your ICP, your ideal client persona, know about you through LinkedIn, know about you through banners on the web, through retargeting, matched audience ads, know about you through outbound email, know about you from affiliates. Let's start by talking about account-based marketing. So account-based marketing list building is the first pillar for mid-market and enterprise B2B SaaS. Now, if you're B2C SaaS or you're SMB SaaS, you don't really need to do ABM lead list building. But if you're selling a product for $2,000 a year or up, you need to start by building a comprehensive list of your entire total addressable market. You want to use lead prospecting engines like Apollo, Instantly, LinkedIn Sales Navigator. One of the things we did when we were bootstrapping SaaSRise back in 2023, a few years ago, is we built a list to start of 500,000 SaaS CEOs and founders globally. We found pretty much every SaaS CEO and founder in the English-speaking world. Now that's thinking big, and we were able to get that list of everyone in our target market built for about $20,000. It wasn't that expensive. And once we had that list of 500,000 SaaS CEOs, we reached out to them via cold email using Instantly. We took the people that engaged and we built a warm email list with them. We did matched audience ads and then followed up those matched audience ads. The people that clicked would then get retargeted. And we took the people who clicked on the cold email, and those people, of course, get retargeted as well. And through a combination of cold email, retargeting ads, and matched audience ads, we were able to scale up to 500 paying SaaSRise members. And the second thing we did was we AI personalized our outbound email. We used Clay and Instantly to AI personalize every single message based on the prospect's LinkedIn profile. That little summary at the top of their LinkedIn profile, we brought that into Clay and Instantly, and then we used Claude and we used OpenAI to write personal messages for every single person. We also were able to use personalized video using Potion. Now, there's a big difference between relevant, personalized outbound B2B email and spam. Spam is email that people don't want, that's not relevant, that doesn't benefit them. What we were doing was sending high quality, personalized emails that actually provided value and were highly relevant to the person. So much so that I would often get emails saying, "Thank you so much for sending me this email." That's what you want when you reach out to people. We were getting a 4% click-through rate on our outbound email campaigns and about a 1.5 to 2% positive reply rate. Those are some great numbers. Anything above a 2% click-through rate and a 1% positive reply rate, you're doing great. Now, the third pillar is profitable digital ads. There's 5 key ad types we have been able to make work very successfully for our clients at SaaS Rise, which is both a community and a digital ads agency. We've been able to make matched audiences, retargeting ads, lookalike ads, thought leader ads on LinkedIn, and paid search work. We used Google, LinkedIn, Meta, and Bing as the 4 big networks. Start with retargeting. Retargeting makes your brand omnipresent and it's inexpensive. You can often reach out to your visitors for about $15 to $20 per 1,000 impressions, CPM. And then once you've got retargeting going, then add in matched audiences. That's where you upload a CSV file of your ABM list, sync it with the social networks, LinkedIn and Meta, and then you sync it with Google as well. And all 3 of those networks start showing ads to your exact audience. It's so cool when you start to see this happen. Now, that will often cost about $50 to $100 CPM per 1,000 impressions. But on LinkedIn, you can do what's called thought leader ads and often get a much lower cost per 1,000 impressions, more about $30 to $40 cost per 1,000 impressions. So then these channels all work together to create an omnipresent system. Figure out which channels are creating the lowest cost qualified leads for you and scale up the spend in those areas. That is the system that will get you to 10 million ARR. Now, before we go any deeper into this, I want to tell you about Pulse, our new technology newsreader. We've spent the last year building this, and we've brought together the best of the web from YouTube, LinkedIn, blogs, podcasts, and traditional news publishers into a single AI-curated tech feed. Check it out at pulse.bot. Now I want to continue the push to 50 million in ARR and talk about how it requires capital and leadership to go from 10 to 50 million. The idea that going from 10 million to 50 million really does require a different skill set. It's less about founder and more about team. It's less about tactics and more about strategy, and less about how do you win this month and more about how do you win this year. It's about building a durable company and driving a cruise ship, not necessarily a speedboat anymore. You can't put it all on your back. You need an experienced team who has done it before that can help you take time off, help you have a little bit more balance in your life, and allow you to transition from founder mode to system mode, from founder-led growth to company-led growth. Now, the first key here is capital strategy. I often talk about never raising more than 1x your ARR in venture capital. Now, why would you not want to raise 50 million if you could? Well, a lot of companies, they get to 5 or 10 million, they go raise that big Series A of 40 or 50 million. And then what happens? Well, the first thing they do is they increase expenses. And there's not as much pressure on them to increase expenses wisely. And so often they significantly increase burn, revenue lags behind, and you end up raising a round at too high a valuation, and you end up having a down round, and you have more expenses and more burn. That's not a good situation. So always raise about 1x, maybe 2x your ARR in venture capital. Now, what are the pros and cons of raising VC money? The pros are fast scale, especially in a land grab where things are moving quickly. The con, though, is often the dilution, having too many people in the room trying to make decisions when you know your customer and product best often. Now, when you get to about 10 million ARR, that starts to give you leverage and allows you to get really great, serious investors in the room to start having some meaningful conversations with you. You're also going to start getting reached out to by private equity firms and firms that might want to acquire you. So once you get to that 10 million mark, though, you're going to need to hire experienced executives. Leadership scaling is the second pillar here. You need to learn how to recruit, hire, and manage an executive team and build a KPI dashboard that everybody understands and ensure that you have a system that can work when you aren't there. Make sure you go on vacation intentionally for 4 weeks every summer so that your team has time to be able to build things and allow you to scale and run and manage the company without you. Now, the key qualities you want to look for in executives, obviously good communication skills, experience in their area, and specifically the ability to get your company to the next revenue mark. If you're at 10 million, you got to get people who have gotten to 25. If you're at 25, you got to go get people that have gotten to 50 or 75, but not too far ahead. You make a big mistake if you're at 5 million and to hire someone coming from a 100 million ARR company, because they're going to need a huge team and they're not going to be willing to roll up their sleeves and do the work like a $10 million or $20 million executive would. And so what you got to do is you got to go one step ahead, but not 2 or 3 steps ahead in terms of revenue. You cannot scale past where your leadership has experienced. Now let's talk about building a moat here as the third pillar. How do you create sustainable competitive advantage? Well, what are the different types of moats? There's brand moats, technology moats, network effects, and economy of scales. At iContact, we built a brand moat and we built a customer scale moat. Back in 2007, the iPod had come out, the iPhone was about to come out, and we just said, you know what? We hear that Steve Jobs is about to launch the iPhone. Let's change our name from IntelliContact Pro, which was our original name, to iContact. And we did that in 2007, just before the iPhone came out. And that allowed us to have a great name. We even purchased the trademark from someone else for $1.3 million. So that was our brand moat. And we got that domain for only $25,000. After you build that brand moat and you have a simple 2 or 3 syllable brand, and you got the executives, you got the 10 million in sales. Now it's about building the system that can run without you while you sleep. Now you want to start thinking about maybe hiring an investment bank to do a Series B, or even taking some money off the table. So let me take a moment and explain how secondary capital and minority recaps work. Well, first of all, what is secondary capital? Well, primary capital is venture capital that goes into the balance sheet of the company. Secondary capital is investment capital, venture capital that goes into your pockets as founders and early shareholders. And so it's a very interesting topic. Now, when you raise a Series B or Series C, oftentimes 20, 30, even 40% of the capital is for secondary share repurchase from the original founders and early shareholders. Now, this can mean liquidity, and it can mean a bigger bank account for you. This becomes possible and doable once you're about 10 million in ARR, not only because you get higher multiples when you're bigger, because now you can become a platform play for the private equity firm if you get bought, but because you can also get secondary capital off the table without losing control of the company. You can still maintain majority ownership of the company even after taking some chips off the table and then going for a bigger bite of the apple later with a bigger team and bigger investors behind you. Now let's talk about the final sprint to 100 million. This requires positioning, diligence, investment banks, and the deal. I want to demystify the M&A process and show you how to position your company for a 9-figure exit. Well, if you're past that 10, 20 million in ARR mark, you're obviously going to need an annual audit from a big 4 financial firm or a quality of earnings report. You're going to need the C-level executives that have been there and done that before. You're going to need annual 409As to make sure you value your stock options properly. You're going to need to make sure you're doing your taxes and accounting properly, of course. Now, you need to start thinking like a buyer 2 to 3 years before you actually want to sell, at least a year before. Now, buyers are going to look for growth rate, profitability, and gross margin. They're really going to look for, is your growth rate, your revenue growth rate, plus your net profit rate equal at least 40%? That's called your rule of 40. If your annual revenue growth rate plus your net profit level equals 40% or more, you're golden. That's the rule of 40. And if you're higher than that, you're going to get above median multiple. Median multiples in SaaS for M&A deals are about 5x revenue. And so if you're above the rule of 40, you're at 50%, 60%, 70% or up, and you're at 15, 20 million in ARR, well, then you're going to get a 6x, 7x, 8x, 9x, 10x revenue multiple. But if you're at, say, 20% revenue growth and 5% net profits, that's a 25% rule of 40. That's below the average, and you're going to get more like a 3x, maybe a 4x. So clean up your financials, clean up your legal structure, make sure you got the right team in place, and make sure you get all your team members assigning their IP to the company. Make sure you've taken care of anyone that you've had to let go. Make sure you do some severance so they sign over their rights and that you can protect yourself. This matters to acquirers because they don't want lawsuits. They don't want IP issues. They don't want trademark issues. And in the due diligence process, you're going to have very long checklists. They're going to take about 30 to 60 days to get through, and you're going to want to make sure you're prepared. Now, during this diligence process, again, it's 1 to 2 months. It's legally intensive. It's financially intensive. And if you don't yet have audited financials or you don't yet have quality of earnings, it can slow the deal down. And if you have messy financials or you've mixed too much of your personal expenses in with the business, it can slow down deals and it can even kill deals. Now, do you need an investment bank to help you sell your company? I do recommend it, particularly if you're past 2 million in ARR. If you're under 2 million in ARR, just go use acquire.com or one of these other marketplaces. But if you're at 2 million or more in ARR, you might as well go get an investment bank. They're going to pay for themselves over and over again. They might take 3 to 5% of the transaction as their commission, as their fee for doing it, but they're going to increase the valuation by 20%, 30%, even 50%. You're going to be able to sell for 50 million instead of 30 million, 100 million instead of 60 million. And they're going to run the process for you because at the end of the day, you've got stuff to do. You're a founder, you're building a business, you've got a successful company, you're scaling, you've got marketing to handle, you've got technology to handle. You don't want to be managing 30 investors and whittling them down to 4 investors and running a tight timeline and having to keep everyone updated. There's a huge value of hiring an investment bank to just handle it for you. In this sale, you can negotiate different terms like how much cash you get up front versus stock, whether there's an earnout over time, and what the employee retention packages are. At iContact, we got an offer to sell to Salesforce.com for $95 million. That was the first offer. And then later they came back and offered to buy us for $100 million. Both of those times, though, they walked away, ended up buying another company, ended up buying ExactTarget and for much more. Now, later, about a year and a half later, we ended up selling iContact for $169 million, but not before we raised a $40 million Series B with $15 million of secondary liquidity for the early founders. They say buying a house is the biggest transaction in your life. Well, it is for most people, but for you, selling your company is probably going to be the biggest transaction of your life. So get the right advisors, get the right financial and legal advisors, and get the right investment bank to support you. Now, when it's finally done and you sign the dotted line and the money gets wired to your account, congratulations, you've made it through, and you want to make sure you save that nest egg. One of the mistakes I made after I sold my company at 27, a little bit too young, was I didn't save up enough. I invested in 33 angel investments. I invested in some real estate, and I wish I would have put more of that money into safer investments. That's the thing I would have do differently today. So if you have that big exit, put the money in muni bonds, put the money in index funds, put the money in real estate, something safe and simple, and then keep the risk in the future companies that you start. Keep the safety in the public stocks and the muni bonds and the index funds and the real estate that you have. To finish off this video, I want to share some hard-won wisdom to help you as a listener and viewer today avoid some future mistakes. So I want to talk about what I'd do differently if I were to build iContact all over again. Well, first, I would focus on the unit economics even earlier. I would probably raise from an even better quality or better brand venture capital firm. We had that opportunity in 2007 to raise from Bessemer Venture Partners, which is a great venture capital firm, Jeremy Levine there. Had I known what I know now, I would have said yes to that term sheet and I would have gone with Bessemer. And so raise from the best quality venture capital firm you can, not necessarily the best terms or whether you have a university connection. I also would be more intentional about building company culture from day one. We did a lot with nonprofit work, with philanthropic work. We gave 1% of our company to charity, did a lot of volunteering. I would have started that earlier in the company. And I would start building relationships with potential acquirers earlier, not just the obvious ones like Salesforce, but with many potential acquirers. I would go out and recruit partners who could become potential acquirers and allow them to put a little bit in the company, invest in a little bit in the company. And I would also do a lot of the same. I would scale up customer acquisition rapidly, make sure we did the land grab, got to 70,000 customers, and get pretty aggressive on grabbing market share. Those are some principles that are timeless and still work today. Building a $100 million company is a marathon, not a sprint. You keep learning from your mistakes. You keep moving forward. You have a positive mental attitude. You get your mental attitude right. You do your cold plunge every day. You do your workout every day. You run. You eat well. And you have the positive mental attitude that you can achieve anything that you truly believe, just as Napoleon Hill said, whatever you can conceive and believe, you can achieve. Now, that might sound corny, but Today, at 41 years old, I know it's one of the most important things in the world is to have a clear, positive mental attitude, believe in yourself, and every single day take a positive step toward your goals. I believe truly that if you start with the end in mind of where you want to get to, you can work toward it every day and have a much higher chance of getting there. Perfection is not the goal. Progress is the goal. So here's what I want you to do next. If you're a SaaS founder with between 1 million and 100 million in ARR, and you want to connect with other founders who are on the same journey, come join us at saasrise.com. We have a community of 500 experienced founders, monthly workshops, Slack channel, WhatsApp group, circle group, peer feedback session, and direct access to me and my team. And if you need a little more hands-on coaching and help, we also have a $20,000 B2B SaaS growth program that we run twice a year if you want to get to the next level as fast as possible. You can get a free 30-day trial at saasrise.com. I'll put the link in the description below. And if you found this video valuable and you want to learn exactly what one of the fastest growing SaaS businesses out there is doing right now, click here to join my video on Clay for a full breakdown to everything they've done to get to a valuation of over $3.1 billion so you can steal what's working for them right now.